The strangest moments in markets are the moments when caution makes you look foolish. I have lived through enough of them to know how cruel that feeling can be. I have watched stocks run, crowds cheer, and smart people act as if the future had already been paid for. I have also watched that same confidence turn into regret faster than most people think is possible. And some of the times when I looked most out of step were the times that left me richer. If you like hearing money explained without the costume and the noise, stay close to me here, because this is one of those stories that sounds simple on the surface and changes once you see the machinery underneath. The title makes it sound like I ignored a rally and somehow got lucky anyway. That is not what happened. I did not get richer by being stubborn. I got richer by understanding what a rally can hide. Most people think a rally is proof. They think rising prices prove strength, prove wisdom, prove safety. I learned a long time ago that price can tell the truth, but it can also flatter a lie. A market can go up because business is getting better, but it can also go up because money is cheap, debt is easy, and people are desperate not to miss out. Those are very different things. I did not always know that as clearly as I know it now. In 1982, I made a big mistake. I was sure the economy was headed for a collapse, and I was wrong. I lost clients, lost money, and got so squeezed that I had to borrow $4,000 from my father to help support my family. That kind of pain burns vanity out of a person if he lets it. What I got from that disaster was more valuable than any hot tip. I stopped asking only, what do I think will happen? And started asking, how do I know, and what if I am wrong? That sounds small, but it changed my life. It changed how I invested, how I hired, and how I built Bridgewater. It made me less interested in looking smart and more interested in surviving reality. So when people say I ignored a rally, I hear something different. I hear that I refused to worship price. I hear that I did not confuse momentum with truth. I hear that I was willing to look early, cautious, and even a little boring while other people enjoyed the party. That has been one of the best trades of my life. I have seen this pattern more than once. In late cycle markets, everything starts to feel easy. Late cycle means the long expansion is getting old, debt is high, and people start believing good times are normal. Risk gets dressed up as intelligence. Leverage gets dressed up as confidence. Leverage means borrowed money, and borrowed money can make gains look bigger right before it makes losses unbearable. That is why 2018 mattered so much to me. Before the mood broke, plenty of people thought caution was outdated. Then the air came out. Bridgewater's Pure Alpha strategy finished 2018 up 14.6% after fees, while the average hedge fund lost about 6.7%, and the S&P 500 ended the year down roughly 4.4% with dividends included. I did not need to win the parade to win the year. That difference sounds technical until you translate it into real life. If one person starts with $100 and loses 6.7%, he falls to about $93. If another gains 14.6%, he rises to nearly 115. The gap between them is not just performance on a screen, it is future freedom. It is sleep. It is the ability to make the next decision from strength instead of panic. This is the part many people miss. Getting richer is not only about catching upside, it is also about refusing to give back years of compounding in one ugly stretch. Compounding means gains, building on top of past gains over time. It is slow, almost boring, until it is broken. And the easiest way to break it is to take a loss so large that the math starts working against you. I have always respected that math. If I lose 50%, I need a 100% gain just to get back to even. That is not a small setback, that is a hole. So if I miss the last 10 or 15% of a late rally, but I avoid the 30 or 40% air pocket that comes after, I have not really missed the game. I have protected the part of the game that matters most. Ask yourself something simple. When you look at your own money, are you trying to win the month or are you trying to protect the next 10 years? That is not a slogan to me. That is the dividing line between people who look rich for a season and people who build durable wealth. I learned that line in pain and I never forgot it. The reason I could ignore parts of a rally is that I was not trying to predict one perfect future. I was trying to survive many possible futures. That is the idea behind the all-weather approach I built. Instead of betting everything on one outcome, I tried to balance a portfolio across four big economic environments: growth rising, growth falling, inflation rising, and inflation falling. I did not want a portfolio that needed one story to stay alive. That sounds abstract, so I will make it plain. Different assets do well in different weather. Stocks often like growth. Bonds often like falling growth and falling inflation. Gold and some commodities can help when money is being weakened or inflation is biting. The point was never to be clever for a quarter. The point was to avoid building a life around one fragile guess. I built that way of thinking because reality changes faster than headlines admit. In 1971, when the United States broke the dollar's link to gold, the rules changed. A monetary order is the system behind money itself. When that system shifts, asset prices do not behave the way old textbooks promise. I learned early that the person who trusts yesterday's rule book in a new environment can get hurt very quickly. That lesson came back again and again. In 1999, people acted as if the internet had canceled valuation, risk, and gravity. Valuation is just the price you pay compared with what you are getting. Great stories can still be terrible investments if the price is insane. I watch people treat price gains like proof of a permanent new age. By 2000, many of them learned the oldest lesson in markets: a beautiful future can still be a bad trade. I know the pushback that comes next. The pushback says this is easy to say after the fact. It says anyone can sound wise once the rally ends. Fair enough. So let me give you a moment when the crowd was still excited. In 2023, as the AI rally caught fire, the S&P 500 was up 15.6% by mid-August, and the NASDAQ 100 was up 30.2%. A lot of people thought caution had become impossible. Bridgewater still leaned bearish on U.S. stocks and treasuries around that time. Bearish just means expecting weakness or lower prices. That was not because I hated innovation or because I could not see what artificial intelligence might become. It was because I was watching the other side of the machine. I was watching yields rise, debt supply grow, and liquidity in the bond market get worse. That last part matters more than it sounds. Yield is the return an investor gets from a bond. When bond yields rise, safe assets become more attractive, and the value of future company profits gets marked down. That is because money in the future is worth less when interest rates are higher. So a market can feel euphoric on the surface, while the gravity underneath it is getting stronger. This is where rallies trick people. A rising market can make everyone feel richer at the same time that the system supporting that market is becoming more fragile. Fragile means it can break under pressure. If government debt keeps rising, more bonds have to be sold. If central banks are no longer flooding markets with cheap money, private buyers demand better returns. Better returns for bond buyers usually mean tighter conditions for almost everything else. I spent decades studying that machine. I do not just watch stocks. I watch debt, rates, currencies, policy, and behavior. Policy means what central banks and governments choose to do. If the government spends more than it takes in, and the central bank is not printing aggressively to absorb that debt, something else has to adjust. Usually that adjustment comes through higher yields, weaker asset prices, or weaker money. That is why I never saw ignoring the rally as a personal sacrifice. I saw it as refusing to buy comfort at the highest price. Comfort is expensive in markets. The crowd pays for it with overconfidence. I have watched too many people buy what feels safe because everyone else is buying it, only to learn later that what felt safe was just popular. Popularity is not protection. If this way of thinking is making you look at markets a little differently, stay with me, because the real difference was never that I disliked rallies. The real difference was that I built a process that cared more about being stress tested than admired. That is a lonely thing in a bubble. It is also a profitable thing when the bubble starts leaking. That process came straight out of my failure in 1982. I stopped trusting my own confidence. I started building a culture where people challenged me hard. At Bridgewater, disagreement was not a threat. It was a tool. I wanted the smartest people I could find pushing against my ideas because the market does not care about my feelings, my status, or my record. It only cares whether reality agrees. That sounds severe, but it is actually kind. It is kinder than false certainty. A portfolio built on ego can feel amazing right up until it collapses. A portfolio built on honest disagreement often feels slower, more awkward, and less glamorous. But it has a better chance of surviving contact with reality. And survival is underrated by people who have not yet seen a real drawdown. A drawdown is the fall from a peak to a low. It is what turns pride into damage. I have seen people chase a rally from 100 to 120, feel brilliant, then ride it down to 72 after a 40% drop. They were right in public and wrong in private. I would rather look a little late and still have my capital. Capital is the base money that gives me future options. That is a big part of why I ended up richer. Not because I guessed every turn, not because I sat in cash forever. In fact, there were times when I said cash was trash because inflation was eating its value and real returns were negative. Real return means what is left after inflation. But even that view was never meant as blind cheerleading for risk. It was about understanding the environment, not worshiping one asset. Then the environment changed. In the first half of 2022, the Federal Reserve raised interest rates hard to fight inflation. The S&P 500 fell about 20% in that stretch. Bridgewater's Pure Alpha 18% volatility fund gained 32.2% in the same period, and it made money in about 65% of the markets it traded, which was better than its usual rate. That was not magic. That was adaptation. Adaptation is the whole game. Markets are not a school test where one fixed answer keeps working forever. They are more like weather systems. If I dress for sunshine every day because yesterday was warm, I will eventually get soaked. That is what many investors do. They build portfolios for the recent past, then act shocked when the future arrives in a different costume. Do you see the trap now? If a rally only works while debt stays cheap, rates stay low, and buyers stay excited, is that strength or is it just borrowed time? That question matters more than any chart. I have found that the best investments often start with the most uncomfortable honesty. They begin when I stop asking what feels good and start asking what can survive. There is also a psychological side to this that is impossible to ignore. A rally does not just move prices, it moves status. It makes disciplined people feel old and reckless, people feel brilliant. That social pressure is one of the strongest forces in markets. The fear of missing out can do more damage than bad math because it makes people volunteer for bad math. I have felt that pressure too. I know what it is like to watch a market rise while your caution gets mocked. I know what it is like to see headlines celebrate gains that I chose not to chase. But I also know what comes after enough of those moments. I know that a crowd in love with the present can become a crowd begging for an exit in a matter of weeks. I have seen that movie too many times to confuse it with a new ending. That is why I think about investing more like engineering than entertainment. If I were building a bridge, I would not design it only for sunny days. I would design it for stress, wind, weight, and bad luck. Money deserves the same respect. A portfolio is not a costume for showing off. It is a structure meant to carry me through conditions I cannot fully control. That view becomes even more important when I zoom out past one country or one stock index. The world is not just trading earnings, it is trading power, debt, and confidence in currencies. When the United States runs large deficits and issues more debt, the bond market has to absorb that supply. If buyers demand higher yields, pressure spreads outward. It hits stocks, private markets, housing, and eventually politics. I pay attention to that because money and power are tied together. A reserve currency is a currency the world likes to hold and use. If confidence in it weakens even a little, the effects spread everywhere. I have spent a lot of time studying these long debt and monetary cycles because they shape what seems possible in every shorter market move. A rally can distract people from that. I try not to let it distract me. This is also why institutional behavior matters. Institutions are the big players, like pension funds, sovereign funds, insurers, and central banks. They do not survive by chasing whatever is loudest this month. They survive by managing mismatches between assets and obligations. An obligation is money they know they will need later. When I built strategies for institutions, I had to think about resilience, not applause. That discipline can look dull next to a screaming bull market. But dull is not always a weakness. Sometimes dull means stable. Sometimes dull means I still have room to act when others are trapped. And sometimes dull is exactly what turns into a fortune over decades, because money compounds best when it is not being blown up by ego every few years. By the time Bridgewater grew into the world's largest hedge fund, and by the time my own wealth rose into the tens of billions, the public mostly saw the size. I saw the scars underneath it. I saw the times I was wrong, the times I looked early, the times I looked foolish, and the times discipline saved me from becoming someone else's lesson. Richer was never just a number to me. It was proof that survival has its own upside. If that hits a nerve, hold on to this question. When the next big move comes, will you be holding what is popular or what can survive? Most people do not ask that until after the damage is done. By then, the market has already taught the lesson at full price. I prefer cheaper education. Now, I do not want to sound as if the answer is to hide from every rally. That would be lazy and wrong. Some rallies are healthy. Some are the start of real gains driven by real productivity, real profits, and real shifts in the economy. My point is not to become allergic to upside. My point is to separate a strong move from a crowded move and a productive boom from a debt-fed illusion. That distinction gets clearer when I think in scenarios. One path is a soft landing where inflation cools enough, growth slows without breaking, and the rally broadens. In that world, balanced investors may lag the hottest names for a while, but they still do fine. Another path is higher for longer rates, where inflation stays sticky and bonds keep offering real competition to stocks. In that world, expensive assets struggle to justify their price. A third path is a harder downturn. Growth rolls over, earnings disappoint, debt becomes harder to refinance, and the crowd suddenly remembers risk. Refinance just means replacing old debt with new debt. If the new debt is much more expensive, weak businesses and weak balance sheets get exposed fast. That is when a lot of paper wealth turns out to be confidence wearing a thin coat. There's also a messier path that people dislike talking about. Debt levels stay high, politics gets more heated, deficits stay large, and money itself becomes a louder part of the story. In that world, diversification matters even more. I do not mean blind diversification where I own 100 random things. I mean owning assets that respond differently when the economic weather shifts. So what would I actually take from all this if I were sitting where you are? I would stop measuring success by whether I kept up with the hottest trade in the last 6 months. I would look at how much pain my portfolio can take. I would ask what happens if inflation surprises me, if growth weakens, if rates stay high, or if liquidity disappears when I need it most. Liquidity is just how easily I can move in or out without getting hurt badly on price. I would also keep some humility close. Humility in markets is not weakness. It is protection against self-deception. I would remember that a stock going up is not the same as risk going down. I would remember that a brilliant story can still become a terrible investment if I pay too much for it. And I would remember that missing a noisy stretch of upside is often cheaper than owning a full collapse. That has been one of the quiet edges of my life. I did not need to dance at every party. I needed to leave with my capital, my flexibility, and my sanity. The crowd often mistakes restraint for fear. I do not. I think restraint is what lets me act when everyone else is forced to react. That difference is where a lot of fortunes are really made. So yes, there were times I ignored the rally. I let other people celebrate the easy money. I let them call me cautious, older, out of touch, or out. Then the cycle turned, and the thing they laughed at became the thing that mattered. That is not revenge. It is just the market returning to arithmetic. In the end, I did not get richer by predicting every headline or by chasing every shining object. I got richer by respecting cycles, balancing risk, admitting what I did not know, and refusing to confuse excitement with value. I learned that lesson when I was broke enough to borrow from my father, and I kept learning it as the numbers got bigger. In markets, the money I refuse to lose is often the money that makes me rich.